Well, the Q3 FY24 results of the banking sector witnessed the beginning of the slide in P&L as well as rise in slippages, which is expected to continue in coming quarters. They say that picture says it all. The graph highlights that despite robust loan growth, P&L has been weak for the banking sector. So the strong loan growth of about 4.5% quarter on quarter, the net interest income growth has not been to that level, impacted by the cost of funds. Operating profit was weak on a sequential basis due to treasury income of the PSU banks largely, while PAT declined quarter on quarter for the first time in last 3 quarters, led by provisions which rose for many lenders and weak top line growth as well. Before I begin with the numbers, one of the key highlights of the results was the sharp increase in risk-weight assets for many lenders due to RBI ruling. Highest increase in RWA versus loan growth was seen for the likes of J&K Bank, Axis Bank, Ujjivan Small Finance Bank, Karur Vysya Bank, ICICI Bank, SDFC Bank, SBI, etc. Some of the lenders saw RWA growth being lower than that of loan growth, which included the likes of DCB Bank and Utkarsh Small Finance Bank. Tamil Nadu Mercantile Bank is the only lender to witness RWA decline on a sequential basis. Now, RWA increase has been higher for private banks. It was up 9% quarter on quarter than PSU banks, where it was up 7.8% quarter on quarter. PSU banks have been the big underperformers in terms of PNL in Q3 FY24. Banking sector overall saw the NII growth of about 2.6% quarter on quarter. For PSU banks, the NII growth was below 2%, while that of private bank was about 3.3% quarter on quarter. X of SDFC Bank, overall NII growth was about 2.4% quarter on quarter, and private banks it was up 3% quarter on quarter. Operating profit growth was weak for the sector as well, coming in at 2.35% YOY and about 1.5% quarter on quarter. The drag on operating profit was due to PSU banks, where it declined by 6.8% YOY and about 1% on a sequential basis, largely impacted by the treasury losses. Private banks operating profit growth was at 12.9% YOY and about 3.8% quarter on quarter. X of SDFC Bank, overall operating profit growth was down 1.5% YOY, while it increased by 0.8% quarter on quarter. X of SDFC Bank, private banks operating profit growth was about 7.5% YOY and about 3.6% quarter on quarter. YOY and quarter on quarter decline in operating profit was seen for Bank of India, City Union Bank, Dhanlaxmi Bank and South Indian Bank. Banking sector reported their lowest quarterly profits in last 3 quarters. Overall, part of the sector grew by 15.5% YOY, while it declined by 3.3% on a sequential basis. This was led by PSU banks, whose PAT declined by 9.2% on a sequential basis, impacted by the wage division as well as treasury losses. Ex-SDFC Bank PAT growth was at 11.3% YOY and a decline of 4.8% quarter on quarter. Slippages of the sector declined by 8.4% YOY and about 4.2% quarter on quarter. In this, the PSU bank slippages declined by 7% YOY and more than 14% quarter on quarter. Private bank slippages declined by 9.5% YOY, but it increased by 5.5% quarter on quarter. MFI, rural and semi-urban market exposure actually impacted the slippages in Q3 FY24 for many lenders. Asset quality, on the other hand, is one of the best that you are seeing in last 8 to 10 years for the banking sector. In terms of way ahead for the banking sector, treasury gains may aid in Q4 FY24 earnings for some of the banks, especially the PSU banks. Deposit war is on for the banking sector. However, it will come in at a higher cost. Net interest margin trajectory is on a downward scale, and in the coming quarters, it will continue to remain downward like it did in Q3 FY24. Slippages pain is coming in few segments like MFI, etc. Rural portfolio. You need to watch out for the same, especially in Q1 FY25, since Q4 FY24 or Q4 of any quarter is very good. We will see credit costs getting normalized in the coming quarters, which means credit costs will continue to rise. Return ratios expected to normalize, which means decline in return ratios going ahead from current levels, but it may remain strong.